Hi, welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So this is the second part of a three-part series to discuss the market outlook for 2026. And in this episode, we will focus more on the implications for equities as well as fixed income. I'm delighted to be joined by my colleague, our global market strategist based in Hong Kong, Marcella Chow, in this episode. So thanks for joining us, Marcella.
No worries, thanks for having me.
So let's start with equities. Now, a lot of the pushback from investors around the region is that equities have already done very well, not just in 2025, but really the last 2 or 3 years. And as a result, in some markets, such as the US, valuations tend to be a bit high. Is there still a case for investing in equities?
Absolutely. While price to earnings ratios are above long-term averages in markets like what you quoted just now with an US with S&P 500 and like MSCI Asia Pacific, these elevated valuations are justified by still robust medium-term price to earnings growth. In the US, healthy corporate earnings, rapid AI adoption, resilient consumer demand, and still strong investment are supporting stock performances. A weaker dollar so far this year also boosts overseas business earnings when translated back to US dollar. Year to date, although US may be lagging in terms of market performances, the US had actually been deriving the highest share of its returns from earnings. Tech is the standout, while financials and industrials are also set for a very strong quarter. Lower interest rates and record share buybacks are boosting equity returns by increasing the present value of future cash flows and reducing share counts, which can help drive earnings per share higher. So despite high valuations, the fundamentals remain supportive for earnings and equities in particular, provided investors stay selective and diversified.
So let's zoom into Asia. Again, it's been a really good year for Asian markets.
Indeed.
Northeast Asia, if you look at Taiwan, South Korea, even China and Hong Kong have posted quite a positive year. Southeast Asia and India is a bit slower, but nonetheless, it generated positive return to investors. So how's the global expansion of artificial intelligence impacting on Asian markets, and what opportunities does this create for investors?
Yes, indeed. AI's influence is rapidly expanding, not just within US, but beyond US mega cap tech, with Asian markets increasingly benefiting from the global AI demand. So we are seeing strong AI-related exports, like you said, from Taiwan, especially in servers, GPUs, and electronics, which are offsetting pressure from US tariff uncertainties throughout this year. Korea's Kospi has surged, led by tech stocks on expectations of an AI-driven memory upcycle. Even though ASEAN countries have been somehow underperforming compared to North Asia in terms of AI's influence, we're actually seeing AI affecting ASEAN countries positively too, with we're seeing ASEAN countries investing heavily in AI infrastructure, particularly in data centers like in Malaysia, while Singapore's strategic focus on AI is also attracting further innovation. Within North Asia, we see China. China is also building a very robust, self-sustaining AI ecosystem, supported by policy and research, and recent trade developments have also improved market sentiment. So for investors, this means new opportunities in tech supply chains, no longer just within US, but broadening out beyond US and into Asian countries, particularly within infrastructure and companies positioned to benefit from AI adoption and innovation across Asia.
So given the current market landscape, and I think one of our emphasis this year or for 2026 is being disciplined in asset allocation, in diversification. How should investors approach portfolio construction and diversification in the context of equities in the new year?
Indeed, discipline will be the cornerstone for investment for 2026. And in today's environment of high valuations and potential volatility, active portfolio construction and diversification remains very crucial. So investors should focus on reducing concentration risk and rotating into sectors and regions with more attractive fundamentals and valuations. So within Asia Pacific, there is significant dispersion in stock fundamentals, making an active approach very essential. Defensive sectors like utilities and staples have provided stability, while real estate offers attractive dividends. And value sectors such as financials and energy, especially within China, present high yield opportunities for income-oriented strategies. Covered call strategies in particular can help monetize volatility. As supply chains are repatriated and self-sufficiency increases, industrials and materials also stand to benefit. So ultimately, balancing growth opportunities with resilient income-generating assets will help investors navigate uncertainty and position portfolios for success in 2026.
Yeah, absolutely. So I think, when we talk about diversification, I think historically in Asia or in Asia Pacific, a lot of investors, especially retail investors, focus on the US and the home market. I think it does make sense to broaden out their reach, even within a greater number of markets across the Asia Pacific region. As you rightly pointed out, the usage of tools such as covered calls or derivatives also helps to enrich the overall portfolio construction. So definitely not just pure equities, but how do we take advantage of the potential increase in market volatility and try to monetize that. Let's move on to fixed income. Now, in our first part of this three-part series, Riza shared with us our thoughts on the Federal Reserve, as well as for some of the developed market governments in their fiscal position and potential fiscal concern on sustainability. So how does US policy rates and fiscal deficit concerns shape the US Treasury yield market and also returns in 2026?
Yes, in 2026, the trajectory of US policy rates and ongoing fiscal deficit concerns will continue to be key drivers of the Treasury yield curve. We expect the Fed to continue easing, lowering policy rates towards the neutral range of 3 to 3.25% by mid-year 2026. While falling rates should generally guide Treasury yields lower, the persistent fiscal deficits may keep long-end rates elevated, resulting in steeper yield curves. This fiscal monetary tug-of-war is unique to the US, where fiscal expansion and monetary easing are actually counteracting forces. So compared to other developed markets, US Treasuries still look attractive, especially with 10-year yields offering additional income. But then, unlike previous years, we anticipate a wider dispersion of returns across fixed income assets, with performance growing more uneven as the year progresses.
So let's move on to the corporate credit side of things. Again, I think the typical pushback or challenge that we face is corporate credit spreads are already quite tight, reflecting a lot of good news in the markets. But where do you think corporate credit's role in portfolio construction is going to be? And in addition to that, securitized assets. What is the outlook for this particular type of assets in the new year?
Okay. Corporate credits have been a reliable source of yield, supported by strong fundamentals and also low default rates. Both investment grade and high yield spreads, like you said, are at the tight end of historical ranges. And while further tightening seems limited, total yields actually remain quite reasonable for healthy carry. So if credit stress highlights reemerges, they could present attractive entry points for investors. As growth moderates in the second half of 2026, as Rice alluded in the first episode, weaker corporate profits may expose balance sheet vulnerabilities. So reallocating towards higher grade bonds and healthier names is a prudent way to mitigate rising default risk. Securitized assets, on your second question, also look constructive. Persistent housing undersupply supports the mortgage-backed securities (MBS) market, and resilient consumer balance sheets bode well for asset-backed securities (ABS). ABS positive convexity also provide a natural hedge against prepayment risk if the Fed cuts rates faster than expected.
So we focus much on the US, both in government bonds and the credit market so far. Let's again come back to our part of the world. If you look at 2025, emerging market fixed income, Asian fixed income have actually, again, done a pretty good job in delivering return to investors. How should investors approach Asian fixed income in the new year, given the global market backdrop that you just discussed?
Asian fixed income presents selective opportunities. So with central banks in the region slowing monetary easing or pacing their pace going forward in 2026, there is limited room for Asian duration to rally further. But then narrowing interest rate differentials as the Fed keeps cutting rates could see some Asian currencies appreciate against the dollar. But then the pace will likely be modest as central banks continue to focus on currency and also financial stability. More compelling will be the Asian hard currency, sovereign, and corporate bonds, which benefit from improved credit ratings, lower default rates, and also tight market supply. For example, India's recent rating upgrades and also slow new issuances should be able to keep the spreads relatively tight. Overall, diversified yields can be found across the fixed income spectrum, but then active allocation, similar to equities as well, and a focus on quality remain crucial, especially as stretch valuations leave little margin for error. If risk sentiment deteriorates, U.S. treasuries and higher quality names like the high-grade investment-grade bonds will continue to provide resilience and hedge against market uncertainty.
Marcella, thank you very much for your thoughts on equities and fixed income. And also thank you for joining us in this episode. Now, if you want to download our latest 2026 Market Outlook, it is available on our website as well as the Market Insights app. If you want any additional questions that you want to ask us or our team, feel free to reach out to your JP Morgan Asset Management client advisors. In our next episode, we will discuss the market implications for alternative assets and how do we put everything together into portfolio construction and asset allocation. So please join us in our next episode. So if you enjoy this podcast, please consider subscribing and share this with your friends and colleagues. I'm Tai Hui. I'll see you on our next episode of On Investors' Minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.